So today we had a red day in the S&P 500. S&P 500 closed under the 5-day moving average. This is not a good sign. It's been pretty choppy this week, right? So Monday we had this big Clifford candle right here, where the S&P closed below the 5-day moving average for the second day in a row, right? This is what's called an outside day candle. Okay, when the range of this candle, the high and the low, is greater than the previous day's range, this would make it an outside day candle. And it usually comes from it's a signal of a reverse coming, right? When this comes, this is a bearish outside day candle. So it would try to signal to us, hey, it's going to be a reversal coming to the downside. And then, sure enough, the very next day, we had another outside day candle. This time it was a bullish outside day candle, where this was also serving as a reversal candle. So it was like reversing the reversal candle, giving us and showing us signs that the S&P 500 could be heading back higher, which I have a price target up here on 444 to the 446 range. But for the past week, since the 26th of July, SPY has just been choppy. It's been flagging and has been basing. And it, honestly, with the moving average and the trend, I'm going to assume that it's basing for a move higher. Okay, so we got this double bottom here with these long wicks. So an area of liquidity is definitely building up just under around the 434 to 435 range. And I like that entry. Looks like a sweet entry to me because it's just below the 20-day moving average. I like to enter there. We still have the area of imbalance here. This big old area of imbalance here is on the 4-hour chart. You can't really see it on the daily chart. And of course, this is where the 50-day moving average is. And this red area is my area of liquidity, where potential people who would go long in this area would set their stop loss. Okay, so do I think it's gonna head that low? Possibly, but honestly, with the way the price action is, I don't think so. This look like it's basing and it's flagging for a move higher. Okay. Another reason I'm saying this is because looking at the VIX today, the VIX actually closed below the 20-day moving average. Okay, it went all the way up above the 5 to 13. Looked like it wanted to test go up and test this resistance level, because if you see this is a ascending triangle that I have going on here. But instead of heading up, the VIX closed just under the 20-day moving average. Now, it's still above the 50-day moving average, which makes me a little nervous. Okay, because it means there's going to be some volatility. Did I say that right? Volatility around. But the fact that it closed under the 20-day moving average is showing a good sign. Now, I want you guys to remember that the VIX inverses the SPY. It's supposed to go the opposite direction of the SPY. As you can see, we had a red candle here, and the SPY also had a red candle. That, guys, in this case, is a bullish divergence. We have a bullish divergence here. Okay, so could that be a sign that we heading up higher? Could be. Okay, I don't take these divergences too serious. Like, as in, I don't make decisions solely based off of them, but they do assist me in my decision making. Okay, they do help influence me, and I do consider it. So we got a bullish divergence between the VIX and the SPY today. Okay, so the SPY went red today. This should have been a green day. Instead, we had a red day for the VIX, and it closed below the 20-day moving average. And that's a good sign, because if the VIX continue to go down, SPY could head to all-time high, to new all-time highs. All right, remember I got the price target at 444 to the 446 range, and simply because the trend is this is a bull trend, guys. You can call it a bull trap all you want, but it's not a bull trap. It's a bull trend. It's a bull trend. So we want to remain bullish in a bull trend. Okay? So right now, all I see is that it's basing. I don't see anything bearish about this chart right now. I don't like that it's trading, it closed below the 5, but that's not too bad. And considering that we have a bullish divergence between SPY and the VIX, tomorrow looks like it could be a nice day tomorrow, but we'll see. Okay, I'll be looking to enter if it drops below this level, below a little bit below the 435.92 level, and of course I'm looking to enter here because I'm not gonna buy the tip. Okay, I'm buying the dip, but as of right now, I'm gonna stay bullish. Yes, I'm gonna stay bullish, but at the end of the day, we'll see what the price actually wants to do tomorrow. Okay, so for now, I am bullish on the SPY. Moving on to triple Q. Triple Q looking good. Okay, we had this bull flag right here. Yesterday it broke out and it actually closed above the this resistant line. And today it was technically a choppy day. However, it came back. It retested this support level, which was a previous resistance. It came down just a little, taking out the liquidity. Okay, stop loss hunting, if you guys don't know what I'm referring to. Taking out retail trader stop loss and heading back higher. So right now it's holding above the breakout level. So this looks really good. Okay, I have a price target of 371 on the triple Q. Okay, take a look at Apple. Apple, yeah, we had a choppy day with Apple today. It did not break out of this resistant level. However, it is trading above all our moving averages. Okay, so I'm not seeing anything bearish on it. However, I do want to remind you that it is following wick-off distribution and is eerily similar. Okay, if I move these moving averages, it's eerily similar to the wick-off distribution. Okay, but it doesn't mean that has to follow it 100%. There will be some differences, and in a strong bull market such as this, you don't want to call a top. Okay, remember, it's trading above all our moving averages. Even though it had a choppy day today, the trend is still bullish. The chart's still bullish. We have this area of liquidity up here thanks to this double top that was purposely made by the market makers, guys. All right, remember and study how the market moves. You guys think the bulls, when it goes green like this, the bulls are in control, or when it's red, the bears are in control. The bulls are buying. Remember, while the bulls are buying, quote, quote, somebody is selling to them. All right? Somebody is selling to them and allowing them to believe that, you know, it's going to keep on going up without stopping. Until they decide to do some stuff like this, where they trick us out. Okay? So I like to keep my eyes on that, pay attention to what these market makers are trying to do, or what they're trying to get us to do. Okay, so be objective, guys. Don't pay attention to the price. Pay attention to the price action, because if price goes down, you're going to be bearish. When the price goes up, you're going to be bullish. Okay, you'll be easily manipulated. Pay attention to the price action. We're trading above all the moving averages in the middle of a bull trend. Okay? So, I'm bullish on Apple still, bullish on the SPY, bullish on the triple Q. Let's move on to ARKK. Alright, now ARKK, I told you guys vaguely, I will admit, that I am bullish on ARKK, and I explained a little bit of how, using Elliott Wave, how ARKK is, it recently came out of correction. ABC correction right here. I got a lot of moving average. By the way, I'm going to remove the moving average, but as you can see, ARKK is back above all our moving average. I'm talking about all our moving averages. The 20-day, the 200, 5-day, 13, and 50-day. I told you guys yesterday we were going to get a squeeze. I mean, the Bollinger Bands are squeezing, setting up for a big move, incoming move. We got this big Shrek candle today, okay? So this is a good sign. It closed above all our moving averages. Okay, so I'm going to remove them now because I want to explain something to you guys. So one of our viewers yesterday mentioned that wave 4 should not go to the low of wave 1. Okay, so obviously the low of wave 1 is here. That's where it started. So wave 4 comes all the way down to wave 1. Obviously, that's not wave 4, right? It's out of the question. Right, maybe it's a head and shoulders pattern, an ugly head and shoulders pattern or something. But, you know, that's if it drops. So, yes, you are the person, that our viewer who made the comment, who pointed out, made a very good point that wave 4 should not come down to wave 1. That's true. It should not, okay? Now, also in the rules of Elliott Wave, Wave 4 also, the price of wave 4 also should not overlap into the price of wave 1. That might be what our viewer meant. But he was not wrong. He or she was not wrong. But yes. So as you can see right here, this is the top of wave 1 right here. So this Fibonacci level right here, that represents the top of wave 1. So according to the Elliott wave rules, according to the rules, the fourth wave price action should not overlap into it like this, as you can see, right? So that's against our rule. It broke the rules, guys. Okay? Now, here is why I will still consider this the end of wave 4 and this is the beginning of the fifth wave. Here's why I still consider that this is okay. Remember, guys, these things are taught to us as what? The conventional way of doing things. Wave 4 should not overlap into wave 1. That's a conventional thing to be taught, and it's the correct thing, right? That's according to the rules. You know, we're also taught to buy at support and sell at resistance, right? Conventional things, conventional methods. However, a lot of time in trading, conventional methods aren't the right methods to do, okay? We have to understand that we are literally trading against market makers. You know, this is a manipulated market, whether we want to believe it or not, okay? So market makers, guess what? Market makers also know the rules of Elliott wave. Elliott wave is one of the most popular used, you know, strategies amongst retail traders. Of course, these market makers are going to know the rules. They probably know it better than most retail traders. And they know that wave 4 price action should not overlap into wave 1, the top of wave 1. So what? And they know that it shouldn't. And they also know that retail traders believe that. And they will be watching for the price wave 4 to not overlap into wave 1. Because if it does, what do you think they're going to think? What will the retail traders think? They're going to think, oh, broke the rules. This is not, wave 4. They're going to get bearish. They're not, whatever. Easily manipulated, right? Because it broke the rule. It broke something that we was taught. You see these indicators, these strategies, that's how the market makers beat us. They beat us using the indicators and the strategies that we were taught. You guys understand? So I like to identify my areas of liquidity. So let me do something. So where would the area of liquidity be? Let's say none of this wave none of this was here yet. Let's say it was just here. Most retail traders are expecting for ARKK to not go below 114.91, right? Because it's not supposed to overlap into the price of wave 1. That's the rule. So obviously there is an area of liquidity right there where I just added that rectangle. Okay? Because if they're gonna go long, they would have went long just above the top of wave 1, expecting it to go up. Or maybe went long at the 61.8 retracement, which is the actual rule. That's where it's supposed to bounce from. But they know these rules, and they know we know these rules. So how would they manipulate us? Obviously, they would push it down even further, taking out all the stop losses. They go stop loss hunting. And look what happened in this area of liquidity. It bounced right back up. Okay? It's all about manipulation and understanding what they're trying to do, how they're trying to get us. Like in Wyckoff said, the composite man. Look that up. The composite man. They're puppet masters, man. Okay? Remember how the market moves. In order for someone to buy, someone has to sell. Who is providing it? And when we're retail traders are buying, who's selling to us? The market makers. They do these things to manipulate us. And then they pull the rug on us. They fake us out. This was a fake out down here. Got us, and they push it. Look at these vector candles. Bang, bang. Strong green candles. Okay? So that's how I'm going to address that. So yes, it did violate the rules, okay? The conventional rules of Elliott wave. But guess what? We can't be using conventional method to trade in these markets. Or else we'll be easily manipulated. We'll be easily stopped out. Okay, because that's what happened. Most retail traders who believe and know a lot of Elliott Wave didn't think it should have went down here. So when it did, it changed their sentiment only to get played, only for it to reverse. So with that being said, ARKK is trading back above all our moving average, and I'm going to continue to stick by what I said. I am bullish on ARKK. I believe this gap up here will get filled around 142. As you can see, there's the gap. And it's also where our next Fibonacci level is, okay? I believe we'll get to the fifth wave to 142. It won't be perfect move up, of course. All right, we'll get some up and down, some ugliness here and there, but I think we'll get there. All right, so bottom line, bullish on ARKK. Moving on to Bitcoin. Bitcoin, like I said yesterday, want to see it bounce off this 13-day moving average, and it did. Got this nice big green candle. However, it's running right into our 5-day moving average, and you know, I like to see it close above the 5-day moving average, but we are getting some resistance here. Could it go head down lower? Not sure, but you know, the fact that it's struggling to get back above the 5-day is showing some bearish signs. Okay, we had this big green move, guys, and looked like it was a bull trap, fake some people out. I'm not saying we won't get some more upside for Bitcoin, but right now it could be a buying opportunity. I do like that it bounced off the 13-day, but you know, I don't like that it's getting rejected here. But remember, I got it following wick-off accumulation, and if I'm right, we could be around the SOS zone and phase D, and in this SOS zone it gets choppy. Okay, so we'll see what happens. It gets really choppy, and then we'll get another big move to the upside for phase E. So remember, phase D is choppy. Okay, so if you believe in wick-off, you know, definitely try your best to identify the range, because it's gonna get choppy. So identify the range, or wait for the breakout or the retest of the breakout. Okay, so right now, you know, it's looking bullish. It's looking like it's still following wick-off accumulation. We're in phase D. Bitcoin's looking good, but we'll see if it can get back above this 5-day moving average, which is at 39.6K. So we'll see. All right, guys. So last but not least, I want to get our viewer's choice. I've been doing it incorrectly, covering the wrong one, but I think I got it right. This is Payfair from the Canadian exchange. Okay, so I'm looking at Payfair, and it had this big move. This is a young stock. There's not much data for me to work with, but I had this big move. Yes, I'm using Elliott Wave, 5-wave to the upside. Right, so after the 5-wave should come the ABC correction, and according to the rules, right? According to the rules, when it comes to the ABC correction to the downside, which comes after the 5-wave, it should retrace to the 61.8 retracement, which is at 1029. But remember, like I said about ARKK, market makers know this. Okay, so keep in mind, they could try to push it even lower to 1029. So my range that I would look to buy is this bounce off the 50-day. The 50-day is around 975 to 1029. Right, that's the range that I would probably look to enter. Of course, that's like $1. That's like a long ways away, like $1.50. Okay, so you know, right now it's just looking bearish, and when it's in a correction like this, I would wait for it to bottom out or reach a comfortable level. So I would feel comfortable if I was to trade that. I'm not trading this, but if I was, I would look to enter around the 975 to 1029 range, because it looks like it's in the middle of an ABC correction. All right. Now we are seeing some buying pressure, because with this Bollinger Band, you see the Bollinger Band, and Payfair did get out of the Bollinger Band a little bit, so it got a little overextended to the downside. Maybe we'll get a relief rally. Of course, if we see it breaking back above the 20-day, which is 1225, it's possible we could get bullish again, right? But right now, it's looking like it's following this ABC correction to the downside. I'm expecting a bounce, like I said, around the 975 to 1029 range. All right, so you know, I'm sorry I can't give you any more good news. Can't tell you it's bullish or not, because honestly, it just doesn't look bullish. It's looking bearish right now. Okay, so but still, I hope I was able to help. I hope I was able to help you guys stay calm in this crazy market. Speaking of markets, I hope you continue to beat the market, and I will see you all soon.